Reports of a CME outage or related feed instability hit metals mid-rally, and that matters because for a window of time the quality of price discovery got hit. Not the market stopped existing, not everything was fake, but the signal became fragmented and less reliable right when silver was trying to confirm a major zone. I'm not claiming motive, only the mechanical impact. And before we go any further, if you have an official CME incident notice, a status page log, or a broker bulletin with timestamps, drop it in the comments. I'll pin it. Facts beat narratives every time. If all we have is my broker froze, we treat it as observed instability, not proof of anything. Still important, still worth analyzing, but we stay disciplined. Now here's why this is the headline. When a primary futures benchmark feed goes unstable mid-move, 3 things happen immediately, every time. Liquidity thins, spreads widen, execution becomes uneven. That's not drama, that's microstructure. And in a leveraged market like silver, microstructure decides who survives the candle and who gets liquidated inside it. Quick heads up, if you want real-time level updates and dislocation notes as they unfold, I post those on X. Same handle as here, OG John AG, verified only. Ignore fakes. I don't sell signals, courses, memberships, anything. This is education to empower independent thinking. Comment below with where you're watching from and your call for the next 24 to 48 hours. Do we hold the rally structure and accept higher, or does the market use this instability to reset positioning and flush back into support? All right, let's get into what actually happened. Clean, verifiable, and useful. First, what does price discovery quality degraded mean? It means the market's normal process, continuous two-sided liquidity plus reliable dissemination of quotes and prints, took a hit in the moment. Other venues can still trade. OTC desks can still quote. Spot feeds can still print. But the benchmark signal most participants anchor to becomes lower quality for confirmation and execution. And that creates a temporary reality that most people are not emotionally prepared for. Different participants see different truth. Some brokers lag, some brokers widen spreads aggressively, some show stale quotes, some reject orders, some fill you at a worse price, some can trade, others can't. So you end up with a market that's moving, but not uniformly. And that's how you get the weird feeling that something's off, even if the move itself is normal. Now here's the key. None of that proves intent. It proves stress and fragility in the plumbing. And in leveraged markets, fragile plumbing is not a footnote. It's the whole story. Because your risk does not pause when your screen pauses, margin doesn't pause, stops don't pause, risk engines don't pause, broker liquidation logic doesn't pause, only your ability to respond can pause. That's asymmetric risk. And that's why outages or feed instability mid-rally are not a meme. They are a risk event. They degrade the very thing you need most in a fast market, clean confirmation and clean execution. Now, why does it matter that this happened mid-rally? Because rallies are when the system is most sensitive to liquidity, when price is drifting sideways and outage is annoying, when price is ripping through levels and outage can change outcomes. Why? Because rallies stack stops. They stack emotion. They stack positioning. They stack urgency. Breakout buyers chase, short sellers defend, option desks adjust, momentum traders pile in, risk managers tighten limits, market makers widen spreads. So when instability hits during that exact window, you get a nasty cocktail. Uncertainty rises. Uncertainty increases defensiveness. Defensiveness widens spreads. Wider spreads make moves sharper. Sharper moves trigger liquidations. Liquidations reset positioning. None of that requires a villain. It's what happens when a leveraged system trades in a degraded environment. Now let's tie this to the key zone everyone cares about. $90. $90 is not just a number. It's a behavior zone. It's where breakout traders chase, it's where shorts defend, it's where headlines print, it's where your risk committee starts paying attention, it's where this is real starts entering the public mind. And in many cases, conditional, not guaranteed, $90 can also become an options pressure point if open interest is concentrated around the 90 strikes on near expiries. Let me be clear, I'm not doing the lazy thing and saying gamma bites at 90 like it's universal truth. Gamma effects depend on options open interest distribution by strike and by expiry. Some days the market is loaded at 90, some days it's loaded elsewhere, some days it's not loaded at all. So the honest way to say it is this. If OI is clustered around 90 strikes for near expiries, a push through 90 can be amplified by hedging flows. If it's not clustered there, ignore this angle entirely. How do you verify it? Check your broker's options chain. Look at open interest by strike and expiry. If you have access to exchange options OI data, even better. If you don't trade options, don't overthink it. Watch price acceptance. Now, before we go further, I want to ground this paper versus physical tension with 2 reality anchors, because credibility matters. We don't get to talk in slogans without giving you something you can verify yourself. Data anchor number 1, physical premiums and lead times. You can verify this in 60 seconds. Check 2 things. 1. Premium percentage over spot on 1 Oz coins versus bars. 2. In-stock availability versus pre-order lead times. Then compare it to last week. If spot is rallying and premiums remain elevated or lead times remain stretched, physical isn't behaving like a soft market. If premiums compress quickly and inventory floods back, physical demand is cooling, at least temporarily. This doesn't tell you direction tomorrow morning, it tells you whether physical is confirming or fading. Data anchor number 2, COMEX inventory behavior, watch registered versus eligible trends and net daily changes. But keep the wording honest. If registered continues trending lower while delivery behavior stays firm, that can indicate tightening. Not proof, evidence. How do you verify? Use daily warehouse reports, track a weekly trend. One day is noise. A persistent trend is information. Now with those anchors in mind, here's the biggest misunderstanding people have about outages mid-rally. They think the outage is the story. It's not. The outage is the condition. The story is what price does after conditions normalize, because when markets are stressed, they reveal truth by what they cannot do next. If the rally was fake, price will fail quickly once liquidity normalizes. If the rally was real, price will hold and continue once normal conditions resume. That's the clean framework. Now we do scenarios, bearish first, bullish second, because the whole point of this channel is to see both sides and make decisions without emotion. Bearish scenario. The rally was a liquidity probe. Price pushed into a key zone, instability hit, signal quality degraded. Once conditions normalize, sellers step in, and the level fails because acceptance never truly occurred. What does that look like? You see price poke above the level but fail to close above it. You see repeated rejection on retests. You see the reclaimed level flip back into resistance. That is the classic trap signature. Breakout attempt, no acceptance, retest from below, failure. Then the market drifts toward support zones to punish breakout buyers and flush leverage. And here's an uncomfortable truth. In the first phase of a liquidity squeeze, everything sells, even things that are supposed to be safe. If the dollar is firm, equities are weak, and crypto is liquidating, silver can be dragged lower short term even if the structural physical thesis remains intact. That's not because silver is suddenly abundant. That's because forced de-risking doesn't care about your thesis. That's the bearish case. Mechanical deleveraging dominates short-term. Bullish scenario. The rally was real. Instability hit, noise increased. But once the system stabilizes, the level holds. Buyers defend, body closes, confirm acceptance above the key zone. Retests get bought instead of sold. That is how a level flips from ceiling to floor. And in that bullish case, the move becomes a grind higher, not necessarily a straight line. Silver is volatile. Even bullish trends can include violent intraday dips, because positioning is being rearranged in real time. So don't confuse volatility with weakness. Volatility is often the fingerprint of repositioning. Now, the way you avoid getting emotionally manipulated is you stop watching how crazy it feels and start watching what it cannot do. If silver cannot stay below the reclaimed zone after repeated attempts to push it down, that's strength. If silver cannot hold above the reclaimed zone and keeps failing, that's weakness. The tape will tell you after it's clean again. Now, because some of you are traders and some of you are stackers, I'm going to address both audiences clearly. If you're a long-term physical stacker, outages and intraday noise are mostly irrelevant. Your thesis is structural. You care about availability, premiums, supply trends, industrial pull, and counterparty risk. You're not trying to buy the perfect candle. You're building a position over time. Your question is simple. Are dips still gifts? Or are we entering the phase where price begins chasing availability? If you're a short-term trader, outages are not interesting. They are dangerous because your edge relies on clean execution and clean confirmation. When execution becomes uneven and confirmation becomes noisy, your edge collapses. Your question is also simple. Do we accept above the key zone after conditions normalize, or do we fail and trap buyers? Both approaches can be valid, but you must know which one you are. Because if you trade leverage like a stacker, the market will destroy you. And if you stack physical like a trader, you will sell bottoms and chase tops. Now let me make the microstructure piece even clearer, because this is where people either level up or stay confused forever. In a normal functioning market, bid and ask exist. Liquidity providers quote, trades print, quotes update. The market tells you where the real two-sided interest is. In a degraded environment, quotes can lag, spreads widen, liquidity providers step back. Your broker may show a price that's not really executable. Your market order can slip. Your limit order may not fill even when it looks like it should. You can get partial fills and rejected orders. This is why the same candle can feel completely different to two different people. One person gets a clean fill. Another person gets smoked by slippage. One person covers a short. Another person can't get out. That's not moral. That's mechanical. Now, here's the psychological trap people fall into. They experience degraded execution, and they immediately conclude it must be intentional. That's a human reaction, but it's not analysis. The disciplined lane is recognize it as a risk event. Collect receipts. Then watch the market's behavior after conditions normalize, because the behavior is tradable. The motive is usually not. Now I'm going to give you a prioritized watch list because most people lose by trying to watch 10 indicators at once. Tier 1, must watch. 1. Acceptance above the reclaim zone. Body closes. Retests held, not screenshots. 2. The first meaningful pullback level. If we dip, does the market defend the retest? That's where trend versus trap gets decided. 3. Physical signals after the outage. Do 1O's coin premiums and lead times remain firm or compress? That tells you whether physical is confirming or fading. Tier 2. Important but secondary. 4. Margin changes. Margin hikes don't prove intent. They change behavior. They reduce leverage. They force de-risking. If margins rise after instability, expect volatility to stay high. 5. Open interest and delivery behavior. When the updated OI print is available, do the signature math. OI contracts x 5,000 ounces per contract costs paper ounces outstanding. That doesn't mean delivery equals that number. It tells you the scale of paper positioning relative to the physical pipeline. If you want, I'll post the exact OI math once the report updates. If anyone has the latest OI figure right now, comment it with a screenshot and I'll incorporate it. 6. Broader liquidity conditions, dollar, equities, Bitcoin. Phase 1 is liquidation, everything sells. Phase 2 is selection, the market decides what it wants to own. If silver holds up while liquidity is tight, that's a tell. If silver collapses with everything else, that may be forced selling, not thesis failure. Now, let's tighten this into rapid-fire OG pacing so you can actually remember it. Here's what matters. A rally into a key level is a test. A benchmark outage mid-test degrades the signal. Degraded signal creates dislocations. Dislocations create traps. Traps trigger liquidations. Liquidations reset positioning. Then the market reveals the truth by what it cannot do next. Can it hold above the level once conditions normalize? Or does it fail and reverse? That's the whole game. Now, I want to address one more point that critics always use as an easy target. They'll say, silver still trades OTC. Other venues exist. So price discovery wasn't paused. Correct. That's why we don't say paused. We say the quality of the benchmark discovery process degraded and became fragmented. That's accurate. That's defensible. That's useful. And if you want to talk like a professional, you stop using absolutes and you start describing conditions. Now I'm going to lay out a simple what to verify checklist so you don't get trapped in emotion. 1. Find the official incident log if it exists. CME status page, broker bulletin, timestamp notice. If you can't verify it, treat it as reported instability, not fact. 2. Check physical premiums. 1O's coin premium percentage over spot, in stock versus pre-order, compared to last week. 3. Check inventory trend. Registered versus eligible. Net daily changes, track weekly trend. 4. Check options concentration if you trade that. Broker chain OI by strike and expiry. If it's loaded near your key level, expect amplification. If not, ignore. 5. Watch acceptance after conditions normalize. Body closes, retests, behavior, not feelings. That is how you turn noise into information. Now I'm going to close with 3 takeaways and the unresolved tension. Takeaway 1. A CME outage or feed instability mid-rally doesn't prove intent, but it does degrade price discovery quality. It fragments liquidity and execution right when confirmation matters most. That's a real risk event in leveraged metals. Takeaway 2. Rallies are decided by acceptance, not wicks. If the market holds above the reclaim zone with body closes and defends retests after conditions normalize, it's real. If it fails quickly, the trap is active. Takeaway 3, anchor your view in verifiable reality, check 1O's premiums and lead times versus last week, track registered versus eligible trends over time. Verify options OI concentration through your broker chain if you're trading those mechanics. Paper can expand faster than physical supply can respond, and that mismatch is where repricing comes from. Unresolved tension. Was this outage mid-rally noise that helped reset positioning, or a stress signal that the structure is changing and the market is being forced to accept higher? You'll find out by what price cannot do next. Protect your capital. If you trade leverage, respect execution risk or it will destroy you. If you stack physical, don't let intraday noise rewrite your time horizon. Drop your call in the comments, trend continuation or trap and flush, and if you have incident receipts, post them. I'll pin facts. Invest with logic, not hype.